The market is reacting in a major way to Movano Inc., Nasdaq MOVE right now, which is currently trading at $13.33 USD, reflecting a massive surge that, depending on the exact moment you look, is bouncing well over a 200% intraday gain, climbing from a previous close of $4.77. Now, before you look at that percentage and think this is the next high-growth wearable tech story finally hitting its stride, the reality is something far more complex and, frankly, far more interesting than a simple product launch success. This colossal volume, we are seeing tens of millions of shares traded, which is orders of magnitude above the stock's typical average daily volume, is not about the EvieMED Ring, not directly, at least. It's about a complete corporate pivot, a reverse merger with Corvex, an AI cloud computing company. This single piece of news instantly transforms Movano from a struggling, cash-strapped health wearable vendor, a story of promising but slow FDA clearance and a difficult direct-to-consumer launch, into what is essentially a new AI infrastructure pure-play platform. That's the unexpected angle that sent the stock into orbit today, completely changing the expectation investors held for the ticker MOVE. The common ground for most investors who have followed Movano over the last year was an expectation rooted in the digital health sector. They saw a company with an FDA-cleared product, the EvieMED Ring, aimed squarely at women's health, and the ambitious future potential of non-invasive blood pressure and continuous glucose monitoring technology. The narrative was one of a small, innovative player battling giants like Apple stock and Aura, needing to successfully execute a product launch while managing a precarious cash runway and avoiding a Nasdaq delisting notice due to equity deficiency. The reality, however, is that the capital market pressures and the inherent difficulties of scaling consumer electronics and medical device manufacturing simultaneously have forced a dramatic existential change. The expectation was the hard grind of incremental sales growth and regulatory hurdles. The reality delivered this morning is a strategic retreat from that business model, utilizing the public shell of Movano to bring a completely different company, Corvex, an AI cloud computing firm, to the public markets. The stock price spike reflects the market's immediate dramatic repricing of the company's assets and future, based on the assumed value of the incoming AI business, even though pre-merger Movano stockholders are expected to own only a small single-digit percentage of the combined entity, around 3.8% on a fully diluted basis, which is a massive dilution event masked by an enormous percentage gain in share price. This is a classic tension between expectation and reality, where the stock gains not because its original business succeeded, but because it is being replaced by a hotter sector play. Analyzing the recent stock movement, the sheer volume spike today is unprecedented for Movano. It clearly signals a massive institutional and retail frenzy attempting to front-run the AI narrative. When a company with a small market capitalization like Movano suddenly announces a reverse merger with a company valued significantly higher, the stock acts as a compressed spring, rapidly adjusting to the implied post-merger value. Corvex, the AI cloud computing company that is effectively taking over, is valued in the merger at $250 million versus Movano's $10 million prior to financing adjustments. This is not a merger of equals. It's an acquisition of a public listing vehicle. The stock's volatile days range today, jumping from its low to its current price, is a testament to the aggressive accumulation by traders who now view this ticker as a pure-play AI infrastructure asset. We've seen similar volatile massive volume days in other smaller stocks that became associated with the AI or GPU narrative, highlighting the sector's current insatiable momentum, a trend we also monitor closely in the space around NVIDIA stock, though the scale and context are vastly different. The underlying original business, the one investors thought they were buying, centered on the EvieMED Ring. Movano was trying to occupy a space between a high-end wellness tracker and a medical device, targeting women with a product capable of monitoring sleep, activity, heart rate, and other metrics, while actively pursuing FDA clearance for its more advanced features like cuffless blood pressure monitoring. Their business model was a combination of direct-to-consumer sales, hoping to generate steady recurring revenue, and potential B2B partnerships, licensing their technology to pharmaceutical or payer companies. A slow, capital-intensive grind. Older reports showed an operating loss and a rapidly decreasing cash position, necessitating capital raises that resulted in significant shareholder dilution even before this merger announcement. The challenge was always cash flow and execution in a deeply competitive landscape, where established players like Apple stock have immense resources and distribution channels, and other startups are already entrenched. This financial tightrope walk, combined with notices of non-compliance from Nasdaq, set the low expectations that the AI merger news shattered. Now we shift to the future outlook, which is entirely about Corvex. The combined entity, which will eventually be renamed Corvex Inc., pivots completely into providing AI cloud computing infrastructure, specializing in GPU-accelerated infrastructure for AI workloads. Their platform, the Amplified AI Cloud, is marketed as addressing the core challenges of scale, efficiency, and security in AI model training and deployment. The proposed services, which include AI factories, GPU clusters, confidential computing, and inference as a service, place the new MOVE or Corvex ticker directly into the most aggressive growth sector of the current market. This is where the tension between expectation and reality reemerges. The expectation is that Corvex will become a successful niche player in a booming, yet highly competitive sector. The reality is that Corvex, while possessing leadership with experience from Google and Microsoft, is still an unproven, newly public company in a space where capital expenditure for GPUs is immense and competition from hyperscalers like Amazon, Microsoft, and Google is brutal. The combined company has secured some financing, including a $37.1 million private placement and a $1 billion committed equity facility, subject to significant caps and approvals, but the execution risk is extremely high. They have to quickly convert their growing sales pipeline into actual, sustained, profitable revenue to justify the current stock price spike, which is now purely speculation on the future success of an AI platform. For the original Movano stockholders, the silver lining, beyond the current stock price surge, lies in the potential earn-out structure tied to the merger agreement. Pre-merger Movano stockholders are set to receive certain earn-out shares if the volume-weighted average price, VWAP, of the combined company hits milestones of $15 within 5 years and $25 within 7 years. This incentivizes the new management to drive stock performance to specific, high targets, which reinforces the speculative nature of the current trading action. However, the immediate and most tangible risk is the sheer magnitude of the dilution and the fundamental shift in the company's focus. The former medical device operations, including the EvieMED Ring and the proprietary sensor technology, are planned to be marketed for sale or spin-off, confirming that the new management's focus is exclusively on the AI cloud investment. Any investor who bought Movano stock for its health technology potential must now decide if they want to hold stock in a high-risk, high-potential AI infrastructure play. This dramatically changes the conversation for those doing their online investment homework, particularly those who might have used a service like Schwab Intelligent Portfolios or engaged in self-investing on platforms like Fidelity or Interactive Brokers, which require a fundamental understanding of the business they are buying. You are essentially swapping a microcap medical device firm for a microcap AI firm. This is a scenario that underscores the volatile, fast-moving nature of speculative stocks on the Nasdaq, which often see these massive shifts driven by corporate actions rather than organic growth. The technical setup now is one of extreme volatility, with the price action being driven entirely by news and volume, not traditional financial metrics, which remain heavily in the red for the legacy business. The move by the institutional players, though currently unclear in its full scope since institutional holding reports are delayed, is likely to be a mixed bag of early exits from the old thesis and new entrants betting on the AI pivot. For those considering investing sites like Robinhood, where impulse buying is common, the allure of a 200+% gain and the AI buzzword could be irresistible, but it is vital to remember that the new company is still pre-scale and needs immense capital and execution to succeed. The financial due diligence now has to shift from wearable device margins and FDA timelines to GPU supply chain, data center costs, and software platform competitive advantage. This is a complete reset. Now, I want to hear from you. Comment below with what you believe is the single